the shining star at this point. It's outperforming. But there's no doubt the chart pattern on gold miners, this kind of rounding formation, you could argue now this is kind of a little cup and a handle formation with built-in bull flags. This is, if we were to do a cup and handle formation, it's typically the depth of the cup is one other way to measure where it could go when it breaks out. So if I was to just throw that on here, let's just pull the chart down. It breaks over the $100 mark, right? Yeah. So it'll be very interesting to see where this unfolds. The first target I gave you, the $68, is based on the daily chart or that was for silver. Sorry, this is for gold miners. But gold miners have got some pretty good potential to the upside, about 31% if this pattern was to unfold going forward.
And here are the interest rates on the 2-year, the 10-year, and the 30-year bond. And you can see how those levels are spiking up. That's what they mean when they say that. Frankly, here's the bigger lesson. This whole dam is built on promises and lies. Bonds, currencies, deficits. They're all claims backed by trust in governments, right? Full faith and credit. So as long as you trust them, you keep loaning money to them, but trust can wobble. Let me take you down this Japanese rabbit hole, although it really isn't a Japan rabbit hole, it really is a debt rabbit hole. And I want you to picture a giant dam that's holding back the river. For years, governments have been just patching those cracks with new paper debt, new promises, new IOUs. Well, at first, the patches seem to hold and they push all the markets up. But as the water rises, the pressure builds, and each new bond issuance, each new debt instrument issuance is another flimsy patch on a wall that was really, frankly, never designed to carry this much weight. We are at the end of this system, and now the cracks are spreading. Investors, those at the top, well, they see the leaks. They panic. They buy gold. They know that the water, once that water starts rushing through those cracks, there's no stopping it. And that's the global sovereign bond market today. That is a dam built on paper promises, straining under the flood of deficits and inflation and the need to create even more deficits and inflation. So let's just jump right in, because what's actually happening is governments around the world sell bonds, basically, and what those are IOUs, to pay for their spending. But investors are losing confidence. Remember, we talk about that all the time. Confidence in any Ponzi scheme, confidence and new money, those are the two most important keys. Inflation hasn't gone away, deficits are growing, and central banks don't look as strong as they once did.
Government bonds function as IOUs, but they are sustained by a fragile ingredient, confidence. When investors believe governments can manage inflation and repay debts, the system works smoothly. But today, inflation remains persistent, deficits are ballooning, and central banks appear less capable of controlling the turbulence. As faith falters, investors sell bonds, pushing their prices down and interest rates up. Rising borrowing costs hit governments, banks, and pension funds simultaneously. The world's biggest financial market, the bond market, shakes first, and when it moves, currencies and equities tremble with it. Once confidence breaks, cascading effects become unavoidable.
So investors are selling those IOUs, those bonds, which makes the bond prices fall and interest rates rise. Remember this beautiful little sterling silver chopstick. When interest rates go up, the market value of the bonds go down. So in the US, Europe, and Japan, borrowing costs are now at the highest that they've been in decades. And when interest rates rise, governments have to pay more to keep the lights on. And as you can see here, there's the Federal Reserve public debt, but there's the international debt securities. And it's all going in one direction, and that's up. And so it makes things look great on the way up, but you have to be able to pay those debts. And that means that there's less money for schools, for roads, or healthcare. Banks and pension funds who hold tons of these bonds, well, they see their balance sheets shrink. And when bond markets shake, it's the biggest market in the world. Well, derivatives, I would say, is probably the biggest market in the world. And those are opaque. We can't really see it. But when a bond market shakes, currencies and stock markets wobble too, because they've used that debt to prop up their currencies and the stock markets. We've talked about the carry trade, which is borrowing at a lower interest rates and then taking that money and putting it into higher yielding instruments. But frankly, it's like dominoes. When one piece falls, the rest start to tumble as well. So the biggest risk is that governments get trapped. They borrow more to keep that dam floating, but the dam just keeps getting weaker and weaker, not stronger. Now, of course, emerging countries feel it the worst because investors pull money out of their bonds first.
Higher interest rates mean governments must divert more revenue towards servicing old debt. That leaves fewer resources for essential services, from infrastructure to hospitals, deepening political and economic strain. Emerging markets typically crack first, but the pressure has now reached developed economies. Carry trades unwind, funding disappears, and leveraged positions collapse. A single weak link can set off global contagion, just as seen during the 1998, 2008, and 2020 shocks. Debt cannot expand infinitely without cost. When investors flee, even the strongest markets become vulnerable. What begins as a financial correction can quickly evolve into a comprehensive systemic crisis.
But now what we're seeing is that that's trickling over into the advanced economies. You know, debt cannot grow to the sky without a level of repercussions. And that means there's a whole bunch of carry trades that will have to unwind. And that means that stocks and bonds and other things will have to be sold, whether they want to or not. Because once confidence breaks, we could see crisis spread across the world, just like we've seen in past debt shocks. And it's happening all over. So when you ask me what's happening in Japan, well, my goodness, Japan has actually been the poster child since the 90s of how to fight and lose the deflationary battle. Because remember, there's only one way to fight deflation, and that is with inflation. And so they struggled with deflation for decades. Well, they're not struggling with it anymore. Now they've got the inflation on top of it. But again, all those bonds, 15 years, actually they had way more than that since the early 90s. Any of those bonds that are still in the system are way underwater, and we cannot see it. We cannot see it until it's too late. And that's why it's critically important for you to become your own central banker and hold on to sound money. Critically important that you do that, because this is when the bond market broke. And we've talked about this before. This is the interest rate chart, and you can see where there's been a series of lower and lower highs. That is an indication of a negative trend. But you can also see on this chart where that is going, where we hit zero interest rate policy, tried to raise rates, didn't work very well, lowered them again, but now those interest rates are up much higher. Remember, they tested the negative rates. It doesn't work. This is when that bond markets that really started ticking. So treasuries lead the global bond sell-off amid corporate supply surge. They'll say, oh, this, they'll say that, they'll say whatever they want, but here is the reality of it. The Treasury, the 10-year U.S. Treasury, is the foundation of the global bond market. So if that is what's leading the sell-off, well, we've got some much bigger problems ahead of us.
Japan offers a glimpse of what happens when decades of stimulus collide with structural stagnation. After fighting deflation since the 1990s, Japan flooded its economy with liquidity, buying enormous amounts of government bonds. Those earlier bonds, issued at ultra-low or even negative yields, are now deeply underwater as rates rise. The true losses lie hidden inside central banks and institutions, only revealed when forced selling begins. Japan's experience signals what awaits other nations: inflation layered onto decades of accumulated debt with no painless way out. Once the world's safe haven for capital, Japan now symbolizes the limits of monetary engineering.
I mean, it's doing similar to gold. I mean, we can look at it here, like you get a rally up and then it pauses for a while, and then you get a rally up and then it pauses for a while. So this is, I think you just have to look at this. Miners are a little more volatile. They'll shake you up. They'll make some higher highs, some lower lows, and you won't know what to do. And that's exactly kind of what they've been doing. But there's a pause here. And really all we are right now is the same with gold. Gold, they're just in a pausing phase, right? I'm expecting we're going to see this eventually break to the upside. If we zoom into the daily chart, we get a much cleaner look of where we are. It's very similar to the price of gold here. Yeah. We've got this push up, we got a nice bull flag, and it's pointing to higher pricing here at any point. There's a couple different bull flag patterns through here. There was this nice one here and it pulled back. And using simple Fibonacci, I mean, I always use this tool, but to me, it's the most accurate tool there is to identify invisible resistance levels and targets. That's what I love about it, is because most people don't use it. And when things are hitting all-time highs or moving higher, they don't know where to put a target really, but Fibonacci gives us these perfect targets. So based on this previous run and this pullback, and we carry it over, you can see we came right up to the 100% measured move. And so now we're pulling back. So now we have another one unfolding right here. And this will tell us where the next upside target here for miners are, which is around the 90 level. So once they find some traction, I think we could see about a 13% move. What's interesting here is silver has the best opportunity, better than miners.
Today, yields on U.S. and global bonds are spiking to levels unseen in decades. The U.S. 10-year Treasury, foundation of global finance, is leading the sell-off. When its value drops, every asset priced against it feels the shock. Gold and silver markets are pausing, forming technical patterns that often precede aggressive breakouts. Miners, though volatile, reflect deep underlying stress in the financial system. Fibonacci structures and cup and handle formations point toward higher long-term prices as capital seeks safety. Meanwhile, rising yields confirm that governments are losing the battle against the mounting cost of borrowing. The system is tightening rapidly.
Silver is kind of the shining star at this point. It's outperforming, but there's no doubt the chart pattern on gold miners, this kind of rounding formation, you could argue now this is kind of a little cup and a handle formation with built-in bull flags. This is if we were to do a cup and handle formation, it's typically the depth of the cup is one other way to measure where it could go when it breaks out. So if I was to just throw that on here, let's just pull the chart down. It breaks over the $100 mark, right? Yeah. So it'll be very interesting to see where this unfolds. The first target I gave you, the $68, is based on the daily chart that was for silver. Sorry, this is for gold miners. But gold miners have got some pretty good potential to the upside. About 31% if this pattern was to unfold going forward.
And here are the interest rates on the 2-year, the 10-year, and the 30-year bond. And you can see how those levels are spiking up. And that's what they mean when they say that. Frankly, here's the bigger lesson. This whole dam is built on promises and lies. Bonds, currencies, deficits. They're all claims backed by trust in governments, right? Full faith and credit. So as long as you trust them, you keep loaning money to them, but trust can wobble. Sound money that cannot be inflated away. Gold is the primary currency metal. Silver is the secondary currency metal. That doesn't wobble the same way. It doesn't depend on promises. It's like reinforcing the dam with stone instead of paper. And when the flood comes, Stone holds its weight.
The entire financial dam is built on promises, deficits, currencies, and bonds backed by trust rather than intrinsic value. When trust wavers, paper assets crumble quickly. Gold and silver, however, do not rely on political assurances. They remain stable stores of value during periods of monetary upheaval. Preparing means building a foundation on assets that cannot be devalued by decree: precious metals, essential resources, and community resilience. Hyperinflation becomes visible only after it's already underway, which is why preparation must happen before the cracks widen. When the flood arrives, those with solid, tangible assets will stand firm while others are swept away.
So what should we all do? Well, we can't stop governments from patching with paper, but we can choose what we hold in our own hands. A solid, sound money strategy with a foundation of gold and silver means that you are outside of the system owning assets that don't vanish when confidence does, because they're used in every single sector of the global economy. This is not rocket science. It just means that preparing families and communities with gold, silver, food, water, energy, community, and shelter, real value, so that when that dam cracks and breaks, we are not swept away. We can hold strong because we are as independent and self-sufficient as we can possibly be. The bond sell-off is a warning, but don't rely only on paper promises. Build your foundation on sound money, and you will have stability no matter how hard the floodwaters, or how high the floodwaters raise, I should say. And they will raise very, very high, because the next step, I'm sorry. The next step is visible hyperinflation. And that's what I keep trying to warn you about. I can't tell you that this is going to take place at 8:35 on Tuesday morning, but you can't tell me that it won't. And so the whole point of being prepared is to have everything in place ahead of time.